From time to time, we meet with people that we think you might find are interesting, informative, perhaps even inspiring. Today we're going to be talking with Andrew Simpson, who is the head of post-trade at Euronext. Hey Andrew, hi. So glad you could join us.
Oh, thanks.
Andrew, I've been away on holiday for the last couple of weeks. Like many people, I took a whole stack of reading with me. There was the normal sort of classic spy thriller, but there was also some serious reading too. I was trying to get my head around disruptive technologies and the impact that was going to have over the next sort of 3 to 5 years. One of the themes that I came up with and frankly surprised me was this thing called Bitcoin and blockchain technology. Just so that I've got this right, what is Bitcoin first and what's it got to do with blockchain?
Great question, and I think you're absolutely spot on to immediately split the two apart, because what happens quite often is that people who are talking about this just conjoin the two, that blockchain and Bitcoin are the same thing, but they're not. Bitcoin is a cryptocurrency, it's a virtual currency, and it's a currency that is, one could call stateless, but I mean stateless not in a technology sense, but in a jurisdictional sense. It doesn't have a sovereign entity that owns it.
So there's no central bank standing behind it?
That's exactly it. Whereas blockchain is the technology that sits below Bitcoin and is a distributed ledger of all transactions that take place with the Bitcoin itself.
So if I've got this right, blockchain technology is the smarts that makes Bitcoin work.
Exactly. And that's the thing that people are getting excited about at the moment. To the extent that people are saying the disruption that blockchain could create will be the same size as the disruption that the internet created in the 90s.
So, okay, well that's a tremendous claim to make. I'm not sure I believe it, but you know, who knows? But what is it then that makes blockchain technology so disruptive, or potentially so disruptive?
Well, the first thing is that it's a non-repudiable way of setting in place a transaction between two people or between two entities.
So hang on a second. What do you mean by non-reputable?
It means that once the transaction has taken place, as soon as that transaction is confirmed, you can't break it apart. You can't say, you turn around and say, actually, I didn't mean to do the transaction. We may be able to do that with a set of rules, and you can back out of it in a legal way, but you can't get out of the transaction or have anybody else break that transaction.
Okay, so it deals with issues like trust.
Exactly.
Credibility.
Yes.
And does it also verify I am who I say I am and I'm able to execute this exchange or this transaction?
Well, that's a very good point and a great question, because actually part of it is the anonymity that you can have with Bitcoin and blockchain. And so how do I know I'm transacting with the person that I want to? Some would say actually the reason why Bitcoin blockchain is helpful and useful in its current state is because I don't want to know who's behind. I just want to know that the transaction will take place and won't be broken. Now, for financial markets, that creates a degree of concern, because actually in some areas of financial markets I absolutely want to know who's there and that I'm dealing with a trusted third party. So hence what people are looking at is the fact that rather than the current distributed blockchain across the entire network, we have perhaps a closed blockchain or a consortium blockchain where we know that the people coming into that closed network or that consortium have already been judged or authorized to be trusted on that network.
Whenever I hear the words Bitcoin and blockchain, what springs to mind immediately is this is the currency of choice for the bad guys hiding in the shadows. So is this how you overcome those issues?
Exactly, by divorcing blockchain from Bitcoin, and so having blockchain version X, on perhaps a closed network, so using the technology of the distributed ledger and all of the implications that may bring, you actually get away from the association and the stigma of Bitcoin.
So, have I got this right? Bitcoin is almost the proof of concept to prove out the underlying blockchain technology.
It's an interesting way of looking at it. Actually, I think like any technology, like the internet, we had Janet before it and ARPANET. Like any
You're showing your age.
But like any technology, there are initial implementations of it, and then what people do is then search for the trusted longer-term solution that could be used in areas such as financial markets.
So, Andrew, you're in the post-trade world. How could blockchain, how could that technology assist with matching and settlement?
So the blockchain, if we consider it as a trusted transaction, a record of transaction on a distributed ledger, another ledger in the financial markets is the Central Securities Depository, the CSD. The challenges we have right now about trade to settlement is the existing infrastructure and technology means that realistically we can't really do the trade to transaction settlement in anything less than 2 days. Why? It's just been the way that the industry has come together and some of the technologies that are available at the time. We've moved recently, as you know, from T+3 to T+2.
Well, I was going to say even T+2 seems like an ambitious stretch.
But that was a challenge for many organisations.
Yeah, okay.
The interesting thing about blockchain, as its software code, is that because the distributed ledger construct and the trust all exist within the blockchain itself, as soon as you've done a transaction and confirmed it, that confirmation could take place within seconds. At the moment on the Bitcoin, it takes place within minutes. Maybe because of the size of Bitcoin, I've heard numbers of around 10 minutes. And so on a closed network with computing power associated just to that private network, you could get to perhaps less than a minute or maybe a minute. Now, if you were at a minute for confirming the transaction that couldn't be repudiated, you move from T+2 to T almost instant. And in that case, if you're at T almost instant, we move to a situation where the risk capital in the industry to cover the exposure of 2 days is reduced down to perhaps almost nothing. One comment I heard from one of the investors at Santander Bank was that such technology could remove around about $20 billion of collateral from the industry.
So that means faster turns, more liquidity in the market, greater ability to execute and trade.
Exactly.
Well, that sounds disruptive to me.
Indeed.
Thanks, Andrew.
No worries, thank you.